Welcome. In this video, we explore charitable lead trusts. Charitable lead trusts are close relatives of charitable remainder trusts, which I discuss in other videos. A charitable lead trust, or CLT, starts when a donor transfers assets into the trust. The trust makes specific distributions at least annually to one or more charities for a term, that is, for a number of years. The charity that benefits from a CLT is called the charitable lead beneficiary. At the end of the term, the assets remaining in the trust go to one or more non-charitable beneficiaries. For this reason, the non-charitable beneficiary is called the remainder beneficiary. This arrangement differs from a charitable remainder trust in which a non-charitable beneficiary receives distributions during the term, and at the end of the term, remaining assets go to a charity. CLTs present excellent planning opportunities for individuals who do not need additional income, are charitably inclined, and have taxable estates. Through the CLT, the donor essentially gives two gifts, an annual gift to charity and a final gift to one or more non-charitable beneficiaries. The non-charitable beneficiaries are often the donor's family members. They receive the remainder interest, that is, whatever assets remain in the trust at the end of the term. Charities love CLTs because they immediately generate secure income for the charity. By contrast, a charity may not receive a distribution from a charitable remainder trust until decades after the donor funds the trust. Furthermore, with a CLT, the charity usually is assured of ongoing payments because the donor cannot change the charitable beneficiary in the most common form of CLT. The donor benefits from a CLT first by achieving the donor's charitable giving goals. The donor or the donor's non-charitable beneficiaries also receive tax benefits. In fact, tax reduction is the only financial benefit donors receive from CLTs. CLTs do not provide income to the donor or the donor's family, as do charitable remainder trusts or charitable gift annuities. The CLT makes annual distributions to the charity for a term. There is no minimum or maximum payout amount from the CLT. The donor determines payouts that meet the donor's goals. Similarly, there are few limits to the term of the distributions. A CLT could last for a specified term of over 100 years, or could be restricted to the lifetime of a specific individual, that is, a measuring life. The donor typically cannot change the charitable beneficiary. If the donor retains power to change the charity, the trust will be included in the donor's estate and will lose its gift and estate tax advantages. The donor can name the donor's own private foundation or family foundation as the CLT's charitable lead beneficiary. However, to preserve the CLT's tax advantages, the terms of the distribution must prohibit the donor from controlling those funds, and they must be included in a separate account held by the private foundation. The donor may also name a donor-advised fund as the lead beneficiary, because the donor does not have the right to direct distributions from a donor-advised fund. Finally, the donor can name any public charity as the trust's lead beneficiary. The remainder non-charitable beneficiary or beneficiaries receive whatever assets remain in the CLT at the end of the term. The donor often names family members as remainder beneficiaries. The CLT can distribute to a trust for the benefit of the donor's family. If the CLT is carefully structured for this purpose, the distribution to the non-charitable beneficiaries will be free of gift and estate taxes. The biggest tax advantages of CLTs comes from their ability to reduce or eliminate gift and estate taxes. CLTs may also provide a donor income tax relief. The two gifts of the CLT have different tax consequences. The projected amount going to charity is not taxable. However, the projected remainder amount going to the non-charitable beneficiary may be subject to gift or estate tax if the donor has given more than the estate and gift tax exemption amount. The exemption amount is $13,610,000 in 2024. When the donor transfers assets into the CLT, the donor must report and pay gift taxes based on the present value of the projected remainder going to the non-charitable beneficiaries. If the actual remainder at the end of the trust term is higher than the projected amount, the increase goes to the remainder beneficiaries without any additional gift or estate tax. Given that the highest gift and estate tax rate is 40%, the tax savings for remainder beneficiaries could be significant. Gift or estate taxes apply to the projected remainder amount that will go to non-charitable beneficiaries. So how is that amount determined? The remainder amount is the total amount contributed to the CLT minus the present or projected value of the lead interest that will be given to charity. Determining the lead interest starts with the terms of the trust and the Section 7520 interest rate, which the IRS publishes every month. The donor then finds the applicable annuity factor in detailed tables published by the IRS and multiplies that annuity factor by the annual payment to be given to charity. This tax calculation assumes that investments will grow at the initial 75/20 rate. A lower 75/20 rate results in a lower gift or estate tax. If trust assets grow over the initial 75/20 rate, the excess growth will be transferred tax-free. On the other hand, the CLT will not have any tax advantages if its assets underperform the 75/20 rate. A CLT can zero out if it is arranged so the projected amount going to the non-charitable remainder beneficiaries is $0. The charitably inclined donor pays no gift or estate tax when establishing the CLT. If the assets underperform the 75/20 rate, the non-charitable beneficiaries receive nothing with no tax consequences. If the assets outperform the 75/20 rate, all increased growth goes to the non-charitable beneficiaries, gift and estate tax-free. Did you know that estate taxes are optional? A CLT that is funded through a will or trust when the donor dies is called testamentary. Donors can use testamentary CLTs to completely eliminate estate taxes. First, the donor leaves all assets to the donor's family or friends up to the donor's estate tax exemption amount. Then, any remaining amounts fund a zeroed-out CLT that names the donor's family as remainder beneficiaries. The donor's family may receive nothing at the end of the CLE term, or they may receive a tax-free windfall. Either way, the donor's plan completely eliminated estate taxes. The income tax consequences of a CLT depend on whether it is a grantor trust for income tax purposes. Unlike a charitable remainder trust, a charitable lead trust is not exempt from income tax. A non-grantor CLT pays taxes on its income. Normally, this is not a good result because trusts pay income taxes at high rates. However, a non-grantor CLT can deduct distributions of income to charity without any income limitation. In other words, a CLT can deduct up to 100% of its income, thereby eliminating the income tax. The donor receives no income tax deduction for a contribution to a non-grantor CLT. With a grantor CLT, the grantor or donor pays taxes on trust income as if it were the donor's income. The donor can immediately deduct the present value of the gift to the charitable lead beneficiary for income tax purposes. This deduction is limited to 30% of the donor's adjusted gross income, or AGI, for cash donations and 20% of AGI for appreciated property. This deduction can be carried forward for up to 5 years. However, if the donor does not survive the end of the trust term, the charitable deduction will be recaptured when the donor ceases to be the taxable owner of the trust. Charitable lead trusts come in two forms: Charitable Lead Annuity Trusts, or CLATs, and Charitable Lead Unit Trusts, or CLUTs. The Charitable Lead Annuity Trust, or CLAT, pays a fixed amount or percentage of the trust's initial value to charitable beneficiaries each year. The amount paid to charity is established at the beginning of the trust and will not change during the term, regardless of investment performance, unless the trust runs out of assets. The CLAT is the most common form of charitable lead trust because it provides an excellent means for high net worth individuals to pass wealth tax-free to future generations. The CLAT benefits the non-charitable remainder beneficiaries by freezing the annuity amount that will be distributed to the charity and maximizing the amount that will be paid to the non-charitable remainder beneficiaries. The Charitable Remainder Unit Trust, or CLUT, pays to charity, usually annually, a percentage of the fair market value of assets in the trust. Thus, the charity likely will receive different amounts each year. CLUTs are less common than CLATs for two reasons. First, CLUTs require annual appraisal of the assets in the trust, which adds expense to the trust administration. Second, if assets in the trust perform well, CLUTs preserve less of that increase for the non-charitable beneficiaries. I'm Daniel Van Slyke, attorney at law. If you would like to discuss your options for charitable planning, contact me. You can find me at iplanlaw.com.